Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about need for taxation reforms in India. Now coming into the current affair. So if we look into India's tax to GDP ratio, it is very low compared to other countries in the world. So tax to GDP ratio is the proportion of tax that is collected in a country in proportion to its GDP. So it is tax GDP ratio. So the tax GDP ratio of India is very low compared to many other countries. So there is a need to bring in certain taxation reforms in order to bring more people into the tax net, that is to increase the tax base, and this will create more fiscal space. So fiscal space means increase in revenue of the government over the expenditure. This is because tax is one major form of revenue for the government. So taxation reforms are very important for a country like India where the tax to GDP ratio is very less. Now, if you are writing an answer in your UPSC Mains examination regarding any taxation reforms, the first point that you should highlight is the low tax to GDP ratio in India, and that is a reason we are pushing for a taxation reform in the country. So this is the current affair, and based on this we will discuss about the need for a taxation reform in India. But before we begin, we are providing pen drive courses for all competitive examinations including SSC, bank courses, UPSC optional, SSC JE courses, teaching courses, railway examination, defense examination, UGC NET, NABARD, RBI Grade B, UPSC Civil Services Examination, law examinations, various state PSCs, and also for various professional courses. So for more details, you can check our website www.studyiq.com, or you can make a call to any of these numbers for more information. Now moving on with the lecture, let us first understand what is the status of fiscal deficit in India. So what is meant by fiscal deficit? Fiscal deficit is the excess of government expenditure over the revenue of the government. So this is fiscal deficit. And in this context, let us understand FRBMA. So FRBMA aimed at reducing the ratio of central debt to GDP to 40% by 2025. So the objective of FRBMA, that is Fiscal Responsibility and Budgetary Management Act, was fiscal consolidation. Now what is meant by fiscal consolidation? It means reducing government's fiscal deficit and improving fiscal health of the government. So fiscal deficit has to be reduced. It can happen in two ways. One is to reduce expenditure. Second one is to increase the revenue. Now we are talking about increasing the revenue by increasing the tax revenue for the government by undertaking taxation reforms. So when the fiscal deficit comes down, the financial or fiscal health of the government will improve. So this is the aim of FRBMA. Now the government set up a committee to review the FRBM Act in 2016. And this committee's purpose was to review the performance of FRBMA Act in India. So what are the recommendations of the committee? The committee recommended that the government should target a fiscal deficit of 3% of GDP by 2020, which would be reduced further to 2.8% in 2021 and 2.5% in 2023. But in India's case, according to financial year 2017-18, the fiscal deficit was around 5.9 lakh crore rupees. That means it was around 3.5% of the GDP. And now in the current financial year, the government has already touched a fiscal deficit of 114.8 of the full year estimates. Now it's been only 10 months, and within the 10 months itself, it has been 114.8%. So again, February and March is pending for the end of this fiscal year. So it is estimated that the target is 100%, that is 3% of GDP. So definitely the fiscal deficit will cross the target. And one major reason is the lower tax receipts, which has undermined the revenue of the government. Now moving on, let us understand what are the reasons for this increase in fiscal deficit. The first one, the absolute volume of central tax collection increased by 3% in the last 10 years. So this is absolute. That means it includes both direct and indirect. So it has increased by 3%. But what is the problem? The share of direct tax collection declined by 3%, and this is compensated by the rise in indirect taxes. So when we take the direct and indirect taxes together, there has been an increase. But the direct tax collection has declined. Now let us understand the factors in detail. The first one, indirect tax. And within the indirect tax itself, the excise duty collections increased at fastest pace by 80%. We are talking about the last 10 years. So don't think that it is after the GST, all the indirect taxes has been subsumed. No, we are talking about the last 10 years. So in the last 10 years, the excise duty collections increased by 80%, and this is partly because there was an increase in the excise on crude. Because since 2014, there were many instances when the crude oil prices were falling. So in order to control the inflation of crude oil when the prices were low, the excise duty was increased. And that is one major reason why there was a hike in the excise duties. Now coming to direct taxes, the average direct tax collection since financial year 2009 has been around 55% of the total tax collection. That means above half of the total tax collections account to direct taxation. But within the direct taxation, the corporate tax collection has reduced. Now if we look into the statistics, in the financial year 2009, the corporate tax collection was 63% of total direct taxes. But in financial year 2018, it decreased to 56%. So the corporate tax collection has come down. But there was an increase in the personal income tax. So personal income tax increased from 35% in financial year 2009 to 41% in financial year 2018. And the main factor that has led to an increase in personal income tax collection is the increase in the number of taxpayers under the direct tax net in the last 10 years. Now the third factor is the tax to GDP ratio. As we have discussed in the beginning, we do not have an impressive figures regarding tax to GDP ratio. Ideally, what should happen is that when the GDP of a country increases, the tax collection also should increase, because GDP indicates that the output of the country has increased. So with increased output, there should be more productivity plus more job. So there should be increased tax collection also. So this is the basic idea, because when an economy is growing, it is reflected in the GDP. So when GDP increases, business is doing well, profits will be higher, more employment generation, more productivity. So definitely and naturally taxes should be increasing. But this is not the case with India. In India, even though GDP has been on a rise, the tax to GDP ratio is not comparable with other best players around the globe. Now, if we compare it with some statistics, let us take GDP and GDP to tax ratio. Now, in the financial year 2008, the GDP to tax ratio was 17.45%. But in 2017 financial year, it increased only marginally to 17.82%. That means over this 10 years, there has been only a marginal increase in the GDP to tax ratio. But if we take the case of GDP and per capita income, we will see that over this 10 years, GDP and per capita income has almost doubled. So ideally what should happen, when GDP and per capita income doubles, the GDP to tax ratio should also double. But this has not happened, and the improvement is very marginal and negligible. Now let us understand what is the way ahead or what has to be done. The first one is to improve the tax to GDP ratio. And why is tax to GDP ratio very low in India? One reason is the low direct tax base. And this is primarily because a majority of the employees in the country belongs to the unorganized sector or the informal sector. So the informal sector employees do not come under the direct tax base. And that is the reason we have a very low direct tax base in the country. So the direct tax to GDP ratio needs to be increased in order to create more fiscal space, that is to increase the revenue of the government and in order to create a healthy financial situation for the government. And for this, more people need to be brought into the tax bracket. Now, second one is to increase the tax base. According to the Kelkar committee report, it mentions about missing middle. So here, missing middle includes professionals like chartered accountants, doctors, lawyers, etc. who do not pay taxes. And it also recommends that agricultural income above a certain limit needs to be taxed. And also India should promote a cashless economy or less cash economy because majority of the tax evasion occurs in cash transactions. And it is also important to revise the tax slabs. Recently, in the interim budget of 2019, government had provided a rebate for taxpayers up to 5 lakhs. So such kind of tax reforms are also welcome. And another measure is to raise the tax deductions. So under section 80C of the Income Tax Act, certain deductions or exemptions are provided for investments, provident fund, national saving certificates, etc. So such type of deductions or exemptions can be further increased in order to encourage individuals to save more towards their retirement. And also additional deposits in these schemes will help the government to pool financial resources to make long-term investments and to invest in long-term projects. So with these reforms, the tax base can be increased and this will substantially increase the tax revenue of the government, which will help the government to attain a better financial or fiscal health. You can find the PDF of this lecture on my Facebook page, and for any queries regarding your UPSC preparations, you can get in touch with me on my Facebook page or you can email me at joycey.studyiq@gmail.com. Thank you.